want to open this discussion with a simple observation, one that most people overlook because it is uncomfortable, inconvenient, or simply too unfamiliar to fit into the traditional frameworks they rely on. Markets do not move because people understand them. Markets move because people misunderstand them. And in that misunderstanding, pockets of inefficiency accumulate until the weight of reality finally bursts through, collapsing whatever narratives were built on fragile assumptions. I've spent most of my life studying those fractures, those hidden fault lines beneath the surface of the financial world. It's not the stories that fascinate me, but the blind spots, the areas where consensus thinking becomes so dominant that it discourages independent analysis. And today, when I look at the global monetary system, at liquidity structures, at cross-border settlement inefficiencies, and at the growing pressure on traditional banking rails, one conclusion becomes increasingly difficult to ignore. Something foundational is shifting, and XRP is positioned, whether people like it or not, at a critical intersection of that change. That is not a statement of hype, it is a statement of structural reality. When I analyze an asset, I don't ask what people want it to become. I ask what functions it already performs, what problems it actually solves, and what pain points it addresses that the broader market has either dismissed or has not yet recognized. Because the most disruptive technologies in history rarely emerge with applause, they emerge with skepticism. The early internet was dismissed as a niche hobbyist tool. Electric cars were mocked as impractical. Cloud computing was brushed off as insecure. And digital assets, particularly those with real-world utility, have been shoved into categories that do not reflect their purpose. XRP is no exception. But the more I examine the data, and I mean raw settlement metrics, liquidity corridors, friction costs, time delays, regulatory patterns, and institutional behavior, the more obvious the divergence between perception and function becomes. Most people assume markets reward intelligence, but in my experience, markets usually reward patience, discipline, and a willingness to admit when the crowd has stopped thinking. The real money is rarely made where everyone is looking. It's made where no one bothers to look, because they believe they already have the answer. That's why misunderstanding becomes such a powerful force in finance. When enough people agree on a simplified version of reality, they stop questioning it. They stop challenging the assumptions underneath it. They stop examining the finer details that actually determine long-term outcomes. And eventually, their certainty becomes the very thing that blinds them. I've spent a lifetime watching this pattern repeat over and over, whether it was in stocks, bonds, derivatives, or entire markets that people swore were too big to fail. Every time the same principle shows up, the greatest opportunities live inside the blind spots created by overconfidence. XRP is sitting right there today in one of those blind spots large enough to hide an entire category of value. The misunderstanding around XRP isn't about whether people like the technology or not. Liking something has nothing to do with whether it works. The misunderstanding comes from the fact that most people judge digital assets the same way they judge ordinary speculation. They watch the price move, they form an opinion, and they assume their opinion reflects the full picture. But opinions don't move the world. Function does, usefulness does, solving a real problem does. And XRP operates in a part of the financial system that most investors do not bother studying: settlement. It's not exciting, it's not flashy, it doesn't grab headlines, but it's the foundation of the entire global financial structure. When people send money across borders, they assume it moves instantly. It doesn't. What moves is the message that money intends to move, but the money itself crawls through a decades-old system built long before the internet existed. That system is slow, expensive, and full of friction. Yet most investors never think about it. And because they never think about it, they underestimate the value of solving the inefficiency inside it. Misunderstanding grows when the crowd believes something has already been categorized. XRP was put into a speculative bucket early on, and once people label something, they stop studying it. They treat it like a finished product rather than a developing infrastructure. That's where the blind spot forms, because while people argue about price swings, institutions quietly focus on utility. They don't care about hype, they care about what reduces cost, what increases efficiency, and what eliminates unnecessary delays. When you operate at institutional scale, shaving off even a fraction of a percent in friction means billions saved. So, while the average investor dismisses XRP as just another token, the people responsible for moving huge amounts of capital see something different. A tool that solves a very expensive problem. And in my experience, anything that solves a costly inefficiency eventually earns its place, no matter how loudly the crowd doubts it in the beginning. The market's misunderstanding of XRP is not a weakness, it's the opportunity. When people are certain they're right, they stop checking the facts. When they stop checking the facts, they leave the door wide open for anyone willing to take a closer look. And when the truth eventually becomes too big to ignore, the same people who dismissed it will claim they knew it all along. I've seen this pattern with industries, companies, and technologies. The crowd is almost always late because the crowd is almost always comfortable. But comfort is not where returns are made. Returns come from understanding something important before the rest of the world figures out why it matters. XRP is sitting in that space right now, misunderstood, underestimated, and waiting for the moment when misunderstanding finally gives way to recognition. Most people never stop to question the machinery that keeps the global financial system running. Money moves around the world every second, and people take that movement for granted, assuming it is simple, instant, and efficient. But if they looked beneath the surface, they would see something very different. They would see a system held together by outdated processes, fragmented infrastructure, and an enormous amount of capital sitting idle, locked away not because anyone wants it there, but because the system requires it. That trapped capital is what truly defines the inefficiency of global settlement. It isn't measured in millions or billions, but in trillions. And the asset that can unlock even a fraction of that trapped liquidity doesn't just become useful, it becomes unavoidable. This is where XRP steps into the picture, not as a speculative dream, but as a practical tool designed to address a problem most people don't even realize exists. To understand the scale of the problem, imagine the world's banks operating like travelers who must leave money at every airport they visit, just in case they need it there later. That's essentially what Nostro accounts are. They are pools of money banks must maintain in foreign countries to facilitate cross-border transactions. Instead of that money being used to fund loans, investments, or productive activity, it just sits there waiting, inactive. When you multiply this across thousands of banks and currency corridors, you end up with trillions of dollars frozen in place. That frozen capital is a hidden tax on the global economy. It slows growth, increases costs, and forces institutions to tie up resources that could be generating value elsewhere. Businesses pay higher fees because banks bear unnecessary expenses. Consumers wait days for transfers because the road they're traveling on wasn't built for speed. Everyone suffers from an inefficiency they don't even know exists. What makes XRP significant is that it directly targets this inefficiency by eliminating the need for pre-funded accounts. Instead of banks holding money all over the world, XRP acts as a real-time bridge, allowing institutions to move liquidity on demand. That means no stagnant pools of capital, no waiting days for funds to clear, no layers of correspondent banks taking their cut along the way. The process becomes streamlined, faster, and dramatically cheaper. Solving a problem on this scale isn't a matter of convenience, it's a matter of economic necessity. When capital becomes more expensive, banks feel pressure to operate more efficiently. When interest rates shift unpredictably, institutions need flexibility. When global uncertainty rises, speed and reliability become strategic advantages, and anything that offers those advantages quietly begins gaining relevance, even if the public hasn't noticed yet. The interesting part is that most investors never factor this fundamental utility into their perception of XRP. They look at price charts, not liquidity models. They look at daily speculation, not structural inefficiency. They look at community emotions instead of economic architecture. That's why the market continues to underestimate the asset. People judge it through the same lens they use to judge speculative tokens instead of evaluating the real-world problem it solves. But institutions don't think that way. They think in terms of cost, friction, speed, and systemic risk. And when you evaluate XRP from the perspective of a bank that moves billions every day, the value proposition becomes almost unavoidable. Cutting settlement delays from days to seconds isn't just convenient, it's transformative. Reducing friction from dollars to pennies reshapes entire business models. Freeing locked capital creates new opportunities for lending, expansion, and investment. The benefits compound well beyond simple transaction savings. What people often forget is that the world doesn't change when something new is invented. The world changes when the old system becomes too expensive to maintain, and the old settlement system is reaching that point. Rising global debt, stricter liquidity requirements, and increased volatility are making inefficiency harder to ignore. The more pressure the system faces, the more appealing efficient alternatives become. XRP doesn't need hype to matter. It needs inefficiency. And the system produces that inefficiency every single day. This is why solving the problem of trapped liquidity is so important. It's not about speculation. It's not about betting on a future that may or may not come. It's about addressing a structural flaw that already exists and costs the world trillions. When something solves a problem of that magnitude, it doesn't need permission to become relevant. The market forces its relevance. And while many investors remain focused on surface-level noise, the real value is developing quietly beneath them. The global financial system is being pushed toward greater efficiency, and anything that enables that efficiency has a future larger than most people can currently imagine. XRP is positioned there not by chance but by design. Most people looking at the financial world only focus on what is loud, public, or emotionally charged. They follow headlines, quarterly reports, and market swings, assuming that whatever is visible must also be important. But institutions don't operate that way. They respond to pressure quietly, efficiently, and long before retail investors realize anything is changing. And one pressure that has been steadily tightening is the rising cost of liquidity. When money becomes more expensive to hold, pre-funding becomes a burden. When global uncertainty increases, frozen capital becomes a liability. When settlement delays grow longer during volatility, banks are forced to rethink the way they move money. This is why the shift toward on-demand liquidity isn't a trend, it's a necessity. The current system requires banks to pre-fund accounts all over the world, tying up billions just to maintain the ability to transact. That model made sense decades ago, but in a world where every second has value and every dollar must work harder, inefficiency is becoming impossible to ignore. Imagine a retailer who is forced to stock every possible item in every store, even if half those items never sell. The cost of overstocking would crush business. No investor would tolerate it. No board would accept it. Yet for decades, that is exactly how banks have been forced to operate. Nostro accounts are shelves filled with products that may not move for months. Some currencies barely transact at all, yet banks must still keep large amounts of capital sitting there, gathering dust while carrying opportunity cost. It's an outdated requirement born from a time when digital settlement didn't exist. But technology has evolved, and institutions know it. That is why they're slowly abandoning the old model. Not because they want to, but because the economics leave them no choice. When liquidity becomes more expensive, efficiency stops being a luxury and becomes survival. On-demand liquidity allows institutions to move value instantly without pre-funding foreign accounts. That means they no longer need billions sitting idle across multiple currencies. Instead, they can convert value in real time, freeing up capital for lending, expansion, or investment. The efficiency gain is not just small, it is transformational. Even a modest reduction in pre-funding requirements can save institutions enormous amounts of money, and institutions always follow the math. They may be slow, they may be cautious, but they are not irrational. When the cost of maintaining an old system continues to rise and a cheaper, faster alternative emerges, the shift becomes inevitable. This is where XRP's role becomes harder to dismiss. Its utility strengthens when liquidity pressure increases. Unlike speculative assets that need hype to rise, XRP grows more relevant when the system becomes stressed. When volatility surges and legacy rails slow down, institutions need a tool that doesn't depend on pre-funded accounts or complex correspondent networks. A settlement asset that can bridge currencies instantly becomes more than an innovation. It becomes a structural advantage. The irony is that the average investor doesn't see any of this. They focus on price swings and emotional narratives, while behind the scenes, liquidity demands are reshaping the behavior of major financial institutions. Another overlooked element is how rapidly global conditions are changing. Economic cycles are compressing. Liquidity shortages are happening more frequently. Banks are tightening capital allocation, and geopolitical uncertainty is forcing countries to reconsider their reliance on the old rails. All of these forces push institutions in one direction: find a settlement mechanism that reduces cost, increases speed, and eliminates unnecessary liquidity burdens. As the pressure grows, the cost of staying on the old system becomes greater than the cost of adopting a new one. The shift toward on-demand liquidity is not a matter of opinion, it's a matter of economics. And institutions always align themselves with whatever improves their economic position. XRP's design fits into that alignment naturally. It's not an attempt to replace the financial system. It's an attempt to optimize it. And optimization is something even the most conservative institutions eventually embrace because inefficiency can only survive when money is cheap. In a world where liquidity is tightening and volatility is rising, inefficiency has a very short lifespan. What most investors fail to recognize is that this shift doesn't require public excitement or media hype. It only requires financial logic. Once a cheaper, faster, more flexible settlement option exists, the old model becomes too heavy to carry. The transition happens quietly, gradually, and then suddenly. By the time people realize what has changed, institutions will have already moved. That's how financial evolution works. It rarely announces itself. It happens because the numbers demand it, and that is why on-demand liquidity is becoming the preferred path. Not because it's fashionable, but because the system has outgrown the old structure. XRP is positioned at the center of that shift simply because it solves a cost problem that institutions can no longer afford to ignore. In periods of calm, most people forget how fragile the financial system actually is. They assume that stability is the natural state of markets, and volatility is an interruption. But in truth, volatility is the default condition. Calm is the interruption. And whenever global tensions rise, whether from economic shocks, geopolitical uncertainty, or liquidity shortages, the weaknesses in the traditional banking rails become exposed. Transfers slow down. Banks become more cautious. Settlement delays increase. Money takes longer to move, not because technology isn't capable, but because the infrastructure behind it wasn't designed for speed under stress. It was built for a different era, one where global transactions were rare, slow, and predictable. When markets become turbulent, that old architecture struggles, and people don't realize just how much friction is created until it's already happening. This is where the value of utility-based liquidity becomes clear. Assets that offer speed, efficiency, and reliability gain importance precisely when the old system becomes less dependable. Global volatility creates a strange paradox. Cash becomes more valuable yet harder to move. Institutions want flexibility, but the rails they rely on tighten. Liquidity gets trapped exactly when it's needed the most. And each time the world enters one of these periods, banks face the same problem. They must move money quickly, but the system forces them to wait. The more strain the system absorbs, the slower and more expensive everything becomes. It's like trying to run water through a pipe that narrows EV. Every time pressure increases, the higher the demand, the more restricted the flow. That's the trap that traditional infrastructure creates. When uncertainty rises, the rails are least capable of supporting the load placed on them, and yet people continue assuming that nothing fundamental is wrong. In moments like these, the true value of a fast, decentralized, utility-driven settlement asset becomes obvious. XRP functions differently because it doesn't rely on layers of intermediaries, pre-funded accounts, or slow correspondent networks. When the traditional rails slow down, XRP doesn't. When banks hesitate, XRP doesn't need them to pre-position capital. When volatility makes the old system fragile, XRP remains unaffected by the same logistical constraints. It's not insulated from market sentiment, but it's insulated from the structural bottlenecks that plague the legacy architecture. During stress events, institutions aren't concerned with hype. They're concerned with reliability. They're concerned with maintaining liquidity flow without watching funds get stuck in the system for hours or days. A tool that bypasses those constraints becomes more than an innovation. It becomes a solution. People underestimate how big an advantage this is because they don't see the internal pressures banks face. When volatility hits, delays in settlement compound risks across the system. A delayed payment means delayed reconciliation. Delayed reconciliation means delayed risk assessment. And delayed risk assessment means institutions become more cautious, more conservative, and slower to respond. This creates a feedback loop. The slower the system moves, the more risk accumulates. The more risk accumulates, the slower institutions are willing to move. This is why liquidity-based digital assets gain importance during volatility. They allow institutions to act faster even when the system around them is tightening. Another element most investors miss is that global volatility is no longer an occasional event. It's becoming a constant feature. Markets now swing more frequently, geopolitical tensions shift faster, and economic cycles are compressed. The old system wasn't built for this pace. Efficiency isn't a luxury anymore, it's survival. Assets that offer real-time liquidity solve a problem that becomes more painful every year, and XRP happens to be one of the few digital assets built specifically for that purpose, not for speculation, not for hype, but for moving value efficiently during both calm and chaos. When the world becomes uncertain, the system doesn't need promises, it needs function. It needs speed. It needs the ability to move liquidity without waiting for multiple layers of approval or pre-existing funding. XRP's relevance expands not from excitement, but from necessity. The more the global environment becomes unpredictable, the more institutions gravitate toward tools that reduce friction and maintain stability. That shift doesn't happen loudly. It happens quietly through adoption curves, infrastructure upgrades, and internal cost-benefit decisions that never make headlines. But once the system begins relying on something for efficiency under stress, it rarely goes back. Stability isn't achieved by clinging to slow, outdated processes. It's achieved by adopting the tools that continue working even when everything else slows down. That's why XRP gains importance during volatility, not because it moves with emotion, but because it moves without restriction. When most people think about a shift in global liquidity, they imagine something dramatic, something loud, something that announces itself with crashing markets and front-page headlines. But real structural shifts rarely behave that way. They almost always unfold quietly, gradual, lie beneath the noise of daily market chatter. The fifth keynote points to exactly that kind of shift. The world is moving toward a liquidity environment where speed, efficiency, and settlement certainty are no longer optional. It's becoming the base requirement. And anything that can't meet those requirements will eventually be pushed aside, not because of speculation or hype, but because the system simply can't function properly without an upgrade. That's why digital settlement assets like XRP sit at the center of the discussion, not as a prediction of price, but as an analysis of utility. When liquidity dries up or moves inefficiently, the entire financial machine starts grinding. You see it in FX bottlenecks, delayed cross-border wires, staggered settlement windows, and the friction that forces institutions to hold enormous amounts of idle capital just to keep transactions moving. This isn't theory, this is the daily reality of the global financial system. And just like a company that eventually drowns under its own operating inefficiencies, the financial system has reached a point where the old rails can no longer support modern demand. The important thing to understand is that markets don't reward the flashiest technology. They reward the technology that quietly removes cost. Investors often overlook this because they prefer excitement over silent efficiency. But if you study global capital flows, you find a clear pattern. Technologies that reduce friction always gain adoption, even if most people don't notice it happening until the transition is already complete. The move from physical certificates to digital brokerage didn't create headlines, yet it fundamentally changed trading. The shift from manual clearing to automated settlement didn't excite retail investors, but it revolutionized market speed. Each transition felt obvious in hindsight, but controversial in real time. The same dynamic is unfolding now. Institutions aren't adopting digital settlement rails because they believe in some ideological future. They are adopting them because the cost of not upgrading is becoming heavier than the cost of transitioning. That tipping point is subtle but irreversible. Liquidity is the bloodstream of global markets. When liquidity hits resistance, everything slows: trade, credit, investment, consumer activity, and institutions have spent decades patching the system with temporary fixes instead of structural upgrades. The problem is that temporary fixes eventually compound into systemic inefficiency. So when a digital asset like XRP offers near-instant settlement with minimal collateral requirements, it becomes more than a speculative asset. It becomes a release valve for a system that's been straining for years. Investors who only focus on charts or sentiment often miss this deeper narrative. They're measuring the wrong variables. The question isn't, will people buy it, but does the system need it? That's where the contrarian edge comes from. While most investors are distracted by price movements, regulatory headlines, or social media speculation, the real signal lies in institutional behavior: quiet integrations, liquidity trials, volume corridors, and back-end adoption that never shows up in retail conversations. Markets reprice utility long after utility begins. By the time the broader audience recognizes the shift, the opportunity has already moved. That's why this keynote matters, not because it predicts the future, but because it describes a structural pressure that's already in motion. The demand for instantaneous, low-friction liquidity is no longer optional. It's becoming the cost of doing business. And if history has taught us anything, it's that the assets aligned with the system's true needs, not investor sentiment, are the ones that end up defining the next era of finance. When you look at the sixth keynote, it focuses on a misunderstanding that repeats itself in every major financial transition. People assume that the future will arrive with fireworks, when in reality it arrives quietly, disguised as routine. Markets rarely announce their turning points. They whisper them. And in this case, the whisper is the gradual convergence between traditional finance and digital infrastructure, something most investors either underestimate or misinterpret entirely. The shift isn't about replacing the old system overnight. It's about upgrading the moving parts piece by piece, until one day the entire machine operates differently without anyone remembering the exact moment it changed. What I've learned over years of studying market cycles is that the most transformative innovations are the ones that integrate so seamlessly into existing systems that people barely notice the transition until it's complete. And the danger for most investors is that they mistake islands for stagnation. The biggest misconception surrounding digital settlement assets like XRP is that adoption must be visible to be real. Retail investors want announcements, partnerships, headlines, and explosive volume spikes to validate their expectations. But institutions operate on a completely different wavelength. They adopt quietly, test privately, integrate in controlled corridors, and only disclose once the infrastructure is already essential to their operations. The public rarely sees the beginning, they only see the aftermath. By the time a new system becomes newsworthy, the early positioning opportunity is gone. This disconnect is why so many investors miss structural shifts. They confuse lack of excitement with lack of progress. The sixth keynote highlights the subtle but powerful truth that the global financial system doesn't need hype, it needs solutions. And when a solution genuinely reduces cost, improves settlement certainty, or increases liquidity efficiency, it doesn't matter how loudly people talk about it online. What matters is whether it solves a problem that institutions can no longer ignore. And that's exactly what's happening now. The world is dealing with currency fragmentation, rising transaction friction, inconsistent liquidity corridors, and settlement delays that slow down global commerce. These problems don't create viral moments, but they create pressure that forces markets to adopt tools that help them breathe again. A digital asset with real utility steps into that pressure naturally. And here's the part most investors underestimate. Once a system proves it can move money faster, cheaper, and with less collateral strain, reverting to the old system becomes almost impossible. Markets don't willingly choose inefficiency. Once an upgrade is validated, it becomes the new baseline. Think back to when electronic payments replaced paper checks. Nobody posted charts about it or argued on social media. The transition simply happened because it made economic sense. That is how financial evolution works. Quietly, gradually, irreversibly. The real meaning of this keynote is that the world is already shifting toward infrastructure that requires digital settlement assets to function at full efficiency. Not because people believe in narratives, but because the math forces it. When inefficiency becomes more expensive than innovation, adoption stops being optional. So the question for investors is never when will everyone realize it, but am I paying attention while the rest of the market is asleep? Opportunities don't disappear, they simply move out of sight. And right now, the shift happening behind the scenes is far more significant than the noise happening in front of them.